Ladies and gentlemen, happy Friday to you. It's the end of another week and end of the last full week of January 2011, the first full month of expiration for 2011. Glad to see you all here. Welcome to our open discussion, open forum Q&A session for Power Options applied at radioactive trading, and of course general options information as well. It's good to see you all here. And hope you're all set to have some questions ready and get some good information in before the start of the weekend. Now let's go ahead and just get started. Just want to introduce myself briefly. My name is Michael Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Power Options for the past 8 years. Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. The site was created about 13 years ago, a little bit over 13 years ago, by Ernie Renner. And at that time, it only supported, when it was first created, I think it was only supporting covered calls, and long puts. And of course, as I mentioned, we've expanded it over the past several years to include over 23 different option strategies. And my role with Power Options, I handle a lot of the free coaching sessions and education on the site. These coaching sessions are important if you're a trial member. You can sign up for as many coaching sessions as you want during your trial period. They're completely free. We do not charge for them. And of course, that also carries over if you're a subscriber. As a subscriber, you can schedule a coaching session at any time as well. They are completely free, and we do not charge for them as well. I've co-authored 2 books with Ernie Renner on options trading, one on naked put strategies and one on protective options strategies, married puts and collars, the different combinations of those particular strategies. I am versed in all strategies on the site, on Power Options, and of course other strategies that aren't there as well. However, there are certain strategies I do not trade in my personal account. Things such as iron butterflies, short strangles, short straddles, and naked call positions don't match my personal risk-reward tolerance. I also don't do married calls because I don't short stock normally in my account as well. But I am versed in those strategies, so I can answer any questions that you have, show you how to use the tools for those techniques, and discuss with you some basic management techniques that are popular of some of our other clients, other Power Options clients, and other investors I've talked to over the years. Now, the processes and procedures for this afternoon's presentation, we already have one question coming in. I'll get to that in just a moment. Use the question pod on the GoToMeeting technology to pose a question. Please feel free to ask as many questions as you want. I'll try to get through all of the questions. Now, depending on the volume of questions, I may not have time to answer all of them. We've actually never had that problem before. And if it turns out I need to stay online for an extra 15 or 20 minutes closer to the 6 p.m. hour Eastern Time, I will do so to handle all the questions. Of course, your questions can be about the tools and Power Options, the radioactive trading techniques. I won't give away everything for free, but I'll discuss some of the radioactive trading principles with you. The Power Options Applied Advisory Newsletter Service, or just general option strategy questions, general stock investing questions as well, and general investing education. Now, just some basic ground rules. We've never had a problem with this before, but I always just like to mention it. Please have respect for all attendees and presenters. Consistent negative behavior will not be tolerated. As I mentioned, be patient. There may be a few questions ahead of yours, but we will try to get through all of them. And I want to encourage you to feel free to help us help others. If I'm answering a question about a particular strategy or a particular management technique, and your market experience, your trading experience, you've seen something different or you saw something that I might not have pointed out, please feel free to use the question pod to send that to me, and I'll share it with the rest of the audience as well. Most important, let's have fun. It's Friday. We're getting close to closing the doors here, getting ready to start the weekend, so let's just have some fun, get some good education under our belts, and move forward into February 2011 and get closer to our next expiration cycle. I'm going to go ahead now and navigate over to the Power Options suite of tools, and the format, of course, we are looking at right now is for a trial account. As you notice, the 4 steps here for those of you on a trial account, I want to encourage you to take advantage of those to become more familiar with the Power Options suite of tools. You can download that free user guide. Flash tutorials are available to help you get better acquainted with the tools. You can access those also from the Learning Center that I'm hovering over now underneath the main Home tab. Also in the Learning Center is the archive of the free live webinars. So you want to make sure that you scroll through some of those if you're just getting started with Power Options as well. The free live webinars, we host a variety of webinars during the week. Towards the end of the presentation, I'll show you our upcoming schedule for next week. and of course the free individual coaching sessions. Now, as I mentioned, I have my first question in there from Greg. It looks like it's come through. Before I get to that question, Greg, I'm going to do one basic thing that I always like to do now during these open discussion presentations. What I want to do is actually, I'm going to actually go into the Other Strategies tab menu. Now, when I clicked on the Other Strategies tab, it shows me on the right the available strategies I have selected: married put, covered call, long call, bear call credit, iron condor, and so forth. I can choose to remove any of the listed strategy tabs I have and add other ones into it. What I'm going to do here is just actually reset to the default settings. So I want to have the covered call, naked put, bull put credit. And we might change that later on based on the questions that come in. If we want to look at some condor strategies, for example, or diagonal spread, or calendar call, or calendar put questions, we'll add those into the menu. What I wanted to do at the beginning here is I'm going to go into the main naked put menu, selling a naked put, expecting the stock to move up. And I'm going to go into the search tool. Now, what I wanted to do here was just illustrate a quick way to identify just those stocks, for example, that offer weekly options. What I'm going to look for is just the at-the-money strike, at-the-money naked put strike for all stocks, indexes, and ETFs that have weekly options that will expire next Friday. These were released on Thursday. Yesterday, as a matter of fact, yesterday morning is when the new series of weekly options comes out. So to start, I'm going to scroll down to the bottom of the naked put screen, and I'm going to click on Clear these settings. Now, the first thing I want to do is set my option expiration time frame. Now, I don't want to look, I can look directly in February, but if I don't use any other limitations, I'm only going to be looking at the, I'm going to be looking at the February weekly options that are available and the regular expiration. I don't necessarily want to do that. So I can simply filter using the days to expiration. I can look in February, but select to see only those options that expire between 2 and, let's say, 2 to 8 days from now, to next Friday. I could also simply select all months and select that as well. The reason why I'm selecting 2 here is because right now the weekly options that expire today, that expired this Friday, are still in the system. I could put 1 to 8 and that would filter those out because technically the options that expire today have a 0 expiration. Now, to sort of set my range at the money, what I'm actually going to do is set the number of strikes out of the money. I can look for specific strikes in the money or out of the money, but I'm going to show out of the money 1-to-1. Now, the reason why I like to always do this at the beginning of this session is I'm trying to see the total count of securities that appear in the list. Now, the last time I looked, 2 weeks ago, we didn't have an open discussion presentation last week, but 2 weeks ago when I looked, I believe there were 40 securities that offered weekly options. I want to see if that number has increased. Nope, we're still at 40. So we don't have any new positions, any new stocks, or any new indexes or ETFs that released options for this cycle. Maybe next week we'll see some new ones that have come out. And of course, on the PowerOptions blog, we'll keep a listing of the new securities that offer weekly options. Now, as I mentioned, you notice, of course, that on this simple search, just looking for the weekly options, that I have ETFs, an ETN available, standard stocks, and also if I went on to the next page, I probably see some of the indexes. Let me just click on page 2 of our results, and there we go. I have the S&P 500 index and the S&P 100 index as well, NASDAQ 100, so I've got my indexes and my ETFs weekly options as well as my stocks. Now, if I wanted to filter this, I'll just scroll back down to the bottom and go into the recommended list section where I can screen against specific company lists, just the IBD 50, the IBD 100, the NASDAQ 100 or the S&P 5-star list. If I just wanted to see those securities, those weekly options on the indexes, ETFs, and holders, simply click the link here to screen specifically against those positions and hit submit. I still have the weekly expiration time frame selected, and I'm only looking for those strikes that are at least 1 strike out of the money. But now I've filtered out all of the stocks, so there's only 16 ETFs and indexes that offer weekly options. Technically, there's 17. One of the securities that offers weekly options is VXX, which is actually an ETN. It's not an ETF. It's not an index, but it's not really a straight stock either. So there's technically 17 ETF indexes and ETNs, that offer the weekly options? Well, if I wanted to go back, of course, and just look at the stock results, the weekly options on the standard stocks, I'd go back to that recommended list section and simply select no lists to open it back up. It's still restricted to my days to expiration and only one strike out of the money. And now I'll remove indexes, ETFs, and holders from the remove stock lists. Let's click submit. And now we'll see just those standard stocks and the ETN as well. And there's the VXX, the short-term futures ETN, the volatility index short-term. So there's technically 23 stocks that offer weekly options, 16 ETFs and indexes, and 1 ETN. And next week at the beginning of the presentation, what we'll do is run that search again and see for the next cycle that'll expire 8 days out from next Friday, or 7 days, I'm sorry, from next Friday, if there have been any new weekly options made available on the stocks or on the ETFs. All right, so that's just a quick run-through of how you can set up the search to identify weekly options. Of course, if I was actually looking for naked puts on weekly options, rather than just using that one strike out of the money, I'd use other filters such as the probability, the naked yield, volume, and open interest to identify which positions I might trade rather than just looking at a straight strike. I want to have it match my criteria. All right, Greg, let me get to your question now, the first question that's come in. And Greg, I also wanted to mention that I talked to the programmer about the alerts for the ex-dividend date that we discussed earlier this week. And I should have that available for you starting next week. I don't think it's going to be available today, but that alerts in the portfolio is going to be available next week. Okay, Greg wanted to know, if I have a spread position in my portfolio and I roll one of the legs, your portfolio only reflects the current open legs and does not include the profit and loss from a closed leg in that position. Cause an inaccurate profit and loss. Is there a way to include all the legs of a position whether they are open or closed? Well, that's funny. I thought it did include that, but let's just take a look. I trust your word, Greg. Let me take a look there. I'm going to go into the profit and loss portfolios. Here's a covered calls I have. Let's see here. Credit spreads. I'm sorry. I wanted to go to the credit spreads portfolio. Let's try there. All right. So we have a February position that we tracked in a previous webinar. In the February, we do have an iron. Nope, the iron condor expired. I apologize. So we have a February position we were tracking in a previous webinar. Sold the 160 put on Amazon and bought the 155. It's a bull put credit spread. Amazon's currently trading at 171.14. So right now this has no adjustments on it, Greg, of course. And I can see, oops, hold on one second. I can see as I scroll over to the far right there that if I liquidated the position now, I'd have a loss of 32% because the option price has changed. It cost me $180. Well, it would cost me $740 to close the position, or $180. And I have an expiration gain or loss of $560. What do I have now? I have the 160 and the 155. Well, what I might do in this scenario, I wouldn't advise doing this, but let me see if I can look at this briefly. Let's see, if I buy to close, if I roll this leg, I'm going to roll the 155 down first to lower strike. Probably result in a loss here. So let's see here. The price to sell to close, my current put is 88 cents. I said I was going to buy the February 150, so I'm going to click the button there for the security. Those weekly options. I want February straight expiration and 150. Oh, so I'm going to make 30 cents on this, but of course I'm going to be losing from the original price I purchased on that particular option. So let me go ahead and run that first. All right. So now it's showing me 193 and 54. And it's showing me a liquidation value of 11.10. Let me take a look at that. Okay, you're right. So that current liquidation value doesn't take that into account. But let me take a look if I go to the position analysis screen for the menu. Okay, so there's my new existing puts, my original net credit of 139. You're right, yeah, it should be taking it into account right there. and my liquidation value should be taking it into account. Okay, so it's not looking at rolling legs on a credit spread. I'll have the programmers look into that, Greg, no problem. So you're absolutely right, it's not looking at it in that scenario. For the roll, I think part of the reason, I'm sorry, not part of the reason, I think the reason that's happening, well, not that that's happening, I'm sorry, but the reason that's never been corrected is most of the subscribers we talk to who are rolling their spreads normally don't roll the spreads down or up. What they normally do is just close the spread for a loss and then go in and enter a new position, or of course let the spread expire worthless. We always actually, myself personally, and I know Mike Phillips, the head analyst at PowerOptions Applied, we typically advise against rolling down a spread or rolling up a spread in the case of a bear call spread if it's getting threatened. The reason why is because we want to try to guide customers away from sort of standing in front of the runaway train or trying to catch a falling knife. If I originally entered a bull put credit spread on Amazon and now it appears that it's going against my existing direction, I feel that it's more conservative to actually liquidate the entire spread. Take a loss. You will take a loss, of course, I understand that, but potentially take a loss on the position and then wait until later on to see a more pronounced stable trend on the position. The fear that you want to avoid, or the thing that you might want to avoid, is when I originally opened this position, and let's say the stock was trading now, Amazon was trading now at 162 or 163, I wouldn't just want to roll both puts down and maybe have a 155 put and buy the 150 put, because if the stock continues to fall, that bull put's going to lose and I'm going to have to readjust it again. So that's just a personal approach of mine and what Mike Phillips at PowerOptions Applied suggests during the credit spreads. Rather than trying to get caught in a pattern where you're just continuing to roll down the spread, it might be better just to exit the spread and then wait to see if that particular underlying security has a more pronounced trend, maybe re-enter a new spread later on after it looks like it's recovered, rather than just trying to manage the losing position by creating a new position, which might cause you more loss if the stock continues to decline in price. But that being said, of course, I will look into that with the programmers and try to make sure that that's established there and that it is tracking there the cost basis and the effective cost per share on a credit spread or a debit spread if the strikes are adjusted using the roll leg or the close leg and open a new leg in the portfolio tools. All right, let's see here. Do we have any other questions yet? Of course, want to prompt anyone to go ahead and send in those questions there? Okay, okay, so I see, Greg. You weren't talking about calendar spreads, or you might have been referring to calendar spreads as well, but I'm sorry, standard vertical spreads, but you're more referring to the calendar spreads. No problem. I'll look at that as well and make sure that it's tabulating the effective cost per share on the long option, the option that you bought, as you're adjusting the short leg on the position, much like it's done with the effective cost per share for a covered call or for a married put, for example. Absolutely. Now, Greg, when you're normally trading those positions, just out of curiosity, are you doing the diagonal spreads where you're using different strike prices, or do you start off maybe using horizontal spreads at one point and then maybe adjust them later? The horizontal spreads, of course, being the same strike. While we're bringing that up, why don't I go ahead and do what I talked about earlier. I'm going to go back into that other strategies menu. And for the time being, let me just go ahead and remove bear call credit. And I'm going to go ahead and add the calendar call spread to the menu. So I'll just highlight it from my available strategies, select add to menu. That'll put it in our next available tab there. And let's go save. And I have calendar calls here, so now I'm going to go into that. There's our calendar call menu, and I'll go ahead and click on, for the time being, yeah, let's go ahead and click on search for the time being. Oh, Greg says, yes, you mostly use diagonals. Good, good. Now, just out of curiosity, anyone else in attendance, have you been researching or analyzing the calendar call spreads? Just kind of curious. Just use the question pod there, type a yes or a no if you're looking at calendar call spreads or diagonal spreads. You can even be calendar puts, for example. I'm just curious. Okay, so a couple of people saying no. A couple of our attendees saying no. Roger says no. All right. Yes. Okay, there's another yes. There's another yes. Okay, good, good. All right, there's something I wanted to bring up. I had a discussion with a customer about this today. during a coaching session. Customer is relatively new to calendar spreads. And let's just talk about diagonal calendar call spreads here, and I'm going to readjust my search a little bit because I want to look at something specific. The field we're looking at above are not recommendations or suggestions. They're just the spreads that match the default criteria. The same thing you'll see in any strategy search. If I went into married puts, if I went into collar spreads, for example, the listing that comes up in the main search tool are just those criteria that match the default settings. Now, I originally set these basic default searches called the initial value set, and in particular calendar call spread, the diagonal spread, what I'm doing is I'm buying a far out in time option. So in this case, I'm looking at options, just a basic default screen of all leaps. So I'm looking for long calls that are at least 8 months out in time. Typically, what this search is focusing on is just those that have a December 2011 expiration, a January 2012 expiration, or a January 2013 expiration. So I'm screening for all leaps. And my short-term series is I'm looking for February. So I'm going to buy a slightly in the money, far out in time call. I'm going to look to sell an at or maybe slightly out of the money short-term call against it. So I'm creating a diagonal spread. May sound similar to a covered call, but it behaves differently because you have two options now instead of a long stock and a short call. Now, the original default settings, in addition to some of the features in the center section where I'm looking for a net debit of less than 15, which transfers to a net credit of greater than negative 15, looking for a max return between 4 and 100%, downside protection of at least 3%, and the delta ratio, which I feel is kind of important. Sometimes you might want to adjust this. I'm forcing the delta ratio, the delta between the two options, to be at least 2.0. I mean, the long option delta must be twice as high as our short option delta. I might lower that a little bit, only look for a delta ratio of greater than 1.8, for example. But what I'm doing here, more simply, for the strategy itself, is I'm forcing the put that I'm buying to be at least 5% in the money or more, and I'm only looking for short options, the option that I'm selling in the near month, to be slightly out of the money, at least 0% out of the money or more. But I'm going to restrict that a little bit further because I didn't like some of the results that appeared. I'm only going to allow this to go 5% out of the money, from 0 to 5% out of the money. I might even restrict it by strikes. I only want to let it go no more than 2 strikes out of the money for the short call. I want to try to keep it at the money if at all possible. And the in the money range, I'm going to actually increase that. I'm going to go 7% in the money or more. I know that seems like a really basic adjustment. It seems like I didn't really adjust it much at all, but it is probably going to make a difference. And something that's not, something that is here that I want to address. In the default settings, when you first start with the calendar spread, I have a field entered here for the net debit divided by the difference in strike prices, the debit to strike difference ratio, to be less than 1. I want the total net debit of my spread, in total net debit I'm paying into the position, to be less than my difference in strike prices. And let me show you why that is important. Let me go ahead and click Submit. All right, and I'm going to clean this up a little bit, okay? I'm going to go back to just some basic, I'm going to click the See More or Less Columns button up at the top here, and that'll link me to the configuration page. I'm going to go ahead and click Reset to Default Settings. I'm going to just make this the results here a little bit more basic. And then I'm going to click Save and Return. That should shorten up my information just a little bit. Okay. So the important features we want to look at here when I'm first analyzing a spread is here's my underlying stock price, $27.69. I'm going to sell a February 29 call for 46 cents. I might lower that. Yeah, I might lower that and want to go to the 28 call, see if that's available as well. And then we're going to buy an in-the-money 2012 January 22.5 call. So I'm selling a 29 call, buying an in-the-money 22.5 on a stock trading at about 27.70. Now my max return if assigned is 19. My total net debit for the position is 629. Shows up as a negative net credit. So I'm paying 629 into this spread. And the spread difference between the two positions, between my 22.5 call that I'm buying and the 29 call that I'm selling, is $6.50. Now, why is that important to have a net debit less than the difference in strike prices. Well, to discuss that further, let's go over to the profit and loss chart for our calendar spread here. This is not a recommendation or suggestion, by the way. I'm not going to go out and place this trade tomorrow or look at or research it on Monday, I should say. I just want to do a quick example. Now, remember, we showed that in this particular position that we have a max return. A calendar spread is different from a covered call. In a covered call, we would have a % return if assigned. And if, for example, in a covered call, if I had bought 100 shares of stock at HIG at $27.69 and sold the February 29 call at 46 cents, what we'd see in the profit and loss chart is that after the 29 strike or above the 29 strike, we would just, if I could draw a straight line with my mouse, we would just have a straight line profit and loss chart that continued. We'd never be able to make more than that. Because this is a time spread, and as we mentioned, the two options, owning a long call reacts differently, I should say, than owning the stock outright. If the stock continues above our short call strike price at expiration, that February 29 call, at expiration, something interesting happens, and what happens there is that our short call automatically goes to a delta of 1, where a long call won't have a delta of 1. So that's why on a calendar spread, as we go above the short call strike price, we notice that our return sort of tails off from the maximum return. It sort of drops down from the maximum return level. Right? Well, the maximum return is earned, of course, if the stock's trading right at the strike price of the call that we sold, in this case the 29 strike. Our short call expires worthless, and our long call has the maximum profit. As the stock continues above that, let's say that the stock was trading at $31 per share. Our short call would go to a delta of 1, and it would cost us $2 to buy it back, where the long option delta would still be gaining. It might only be at 0.85 or 0.9, excuse me. So for that extra $2 move, we only gained $1.80 on the long call, but we lost $2 on the short call now that it went to a delta automatically of 1 at expiration, and that's why it tails off a little bit. Well, what's important here is let's fast forward, and let me just scroll down to the bottom, and we're going to go ahead and say what would happen to our position if the stock was trading, let's keep it simple, at $30 per share on February expiration, $1 above our short call strike price at February expiration on February 19th. So let me go ahead and hit calculate. All right. So what we see now is, as we expected, we're at expiration. The stock's trading at $30 per share. So our February 29 call would have a calculated value of $1. It's $1 in the money. Delta right at 1. So we're paying dollar for dollar. For every dollar, the stock moves above our short call strike price at February expiration. Now we have a 22.5 call, and the stock's trading at $30 per share. So we have $7.50 of intrinsic value. Our 22.5 call is $7.50 in the money. However, the theoretical value, the expected value of that 22.5 call is $8.48. 848 for one contract. Let's round that up for simplicity. Let's just call it $8.50, shall we? So on February expiration, if the stock is trading at $30 per share, the Black-Scholes theoretical pricing model shows us that our 2012 22.5 call would be worth about $8.50. We'd have $7.50 of intrinsic value and $1 of time value remaining on the position. Now, if this scenario occurred on expiration, the stock was trading at $30 on February expiration, and I was out of town, and I didn't make any adjustments, what my broker most likely would do was look at my position and say that my customer has an obligation to deliver 100 shares of stock at $29 that they don't own. However, they do have the right to buy shares of stock at $22.50. So my broker would exercise my 22.5 call, buy 100 shares of stock from me at $22.5, and sell it at $29. What would I get back in that case? Well, I'd make that $6.50, wouldn't I? The difference between $22.5 and $29, I'd have $6.50 of profit at that point. But remember, my original net debit was $6.29. So I'd still have a 21-cent profit on the position. Now, that's not how you would want That's not what you would want to let happen to a calendar spread. And Greg, I know that you're pretty familiar with this because you've been trading diagonal spreads for a while. As I get closer to expiration, if my short call is in the money, if I didn't buy it back beforehand or roll the call up as the stock moved above my short call strike price, I would actually be better off buying to close my February 29 call for $1 and then selling to close my January 22.5 call for $8.50. We're just assuming $8.50 again in this scenario. If I liquidate the position in that fashion, what happens? Well, I collect $8.50 for selling the long call. I take $1 of that to buy to close my short call. So now I have $7.50, and our net debit originally was $6.29. So now I have a profit of $1.21 over my original investment of $6.29. It's better if I just let the position be exercised, or if I exercise the long call and buy shares of stock at 22.5 to sell at 29, I would still make a small profit of 21 cents in this scenario. But what am I denying myself? I'm denying myself the $1 of time value that still exists in the call that I own. This call that I own still has several months to expiration, has about 11 months to expiration. And we have about $1 worth of time value included in this $8.50 potential premium. If I exercise the call to deliver the short call, I'm denying myself that extra $1 of time premium. So I'll make out worse. I'll still make a profit in this case of 21 cents, but I'm denying myself that extra time value. Now, let's say that when we originally opened this position, I didn't have that criteria in there for the debit to difference in strike ratio on the spread to be less than 1. In other words, let's say my net debit was greater than my difference in strike prices. That is a problem, especially if the stock suddenly shoots up and you risk early assignment on your short call if you haven't adjusted it. So let's say that it actually cost us $7 to buy the long call, and we collected 45 cents for selling the January 29 call. Let's take a look what that would look like. All right, let's see. Let's just run this little scenario here in the custom spread tool. Get our calculations going. All right. Whoops. Sorry about that. Apologize for that. I don't know what happened there. Okay, so now what's the problem? Well, I still have a potential profit. In this case, if the stock's trading right at $29 per share, we'd make $109, and that's based on the theoretical long call value that we'd still have on our 22.5 call. But remember, the difference in my strike prices is $6.50. We sold the 29 and we bought a 22.5. If we just look at the straight monetary values of our rights and obligations of the strike prices and our net debit, the months at this point don't really matter. But we've got a January 2012 22.5 call and a short February 29 call. So my total net debit in this fake scenario I put together would be $6.55, or $655 for one contract. And of course now you see the problem. If the stock was trading above 29 and I didn't do anything or make any adjustments, or I got early assigned. I got assigned early and my broker automatically bought shares for me at 22.5 and sold them at 29. I only get $6.50 back from the spread. So I almost locked myself into a 5-cent loss. And if a stock gaps up on you suddenly, that can happen, especially since we're at the tail end of an earnings season. That can come into play. So just for those of you that are doing calendar spreads, the diagonal spreads where you're buying an in-the-money call, far out in time, and selling a short term, I always highly suggest or highly recommend using this debit to difference strike ratio of less than 1, so that your net debit, the price that you're paying into the spread, is always less than the difference in strike prices. So in that case, in a calendar call, if there's a sudden gap up, an unexpected gap up, and you face early assignment where you can't have any control over it, your broker automatically does it for you. Or in the case of the calendar put spread, if the stock suddenly spikes down and you're forced to exercise your long put to deliver the obligation of the short put, well, then at least you make some profit on the position. You're not caught in a losing position because your net debit was less than the total difference in strike prices. All right. So I just wanted to review that, and for those of you that aren't doing calendar spreads, I'm sorry if that was a little bit more in-depth or a little bit more involved than you wanted to go, but I just wanted to showcase that and give a little information there on one of the criteria you might want to consider using in the calendar spreads when you're creating your position. All right. Who has any other questions on a given particular strategy, or on using the PowerOptions tools to identify a strategy, or using the portfolio tools to evaluate tracking a position? I don't see any new questions coming in, so if you have any questions, go ahead and send them to us. While I'm waiting for a new question to come in, just want to remind everyone of a very basic tool on PowerOptions that you can use that will greatly help you. Well, it can help you with just your first view with the market. This is the trial account, and as you see, we have the 4 steps for 4 steps to get better acquainted with the tools. Down below that, we have the pod menu feature where you see, different values of market conditions. Now I have a watch list here which shows stocks that I'm tracking. I have the market activity list here for the different indexes just to give me a broad-based view of what happened today. And I put in some values for the pods for the top stop gainers, upcoming webinars, and the ETF pod as well, where I can view the top gainers for the standard ETFs and top losers. I can change the tab and look at the inverse ETFs, and of course the leveraged ETFs. Now, when you click the drop-down menu here on the Configure My Home to add a new pod, other pods you can add are the earnings announced today, latest stock splits, 52-week highs and 52-week lows, power tips, of course, recent site events, top industry gainers, top industry losers, and top stock losers. Now, if I want to see the 52-week highs today, I'll just click on that, and it'll add it into the next available spot, and I can do the same thing with the new 52-week lows as well. So I'll just add the pod into the next available screen. I can customize it. I can drag pods over into the new menu. If I wanted all of my data over on the right-hand side, I can just move all of my pods over to that one particular side. And of course, you can minimize them as well, just using that blue arrow. Just minimize the pods there to get a better view. And then I can always expand them later using that blue circle again. And of course, if you wanted to remove one of those pods, you just simply click the red X, and then you'll always be able to select it again later on from the drop-down menu from the Add a New Pod feature. So this is just a quick way where you can get a basic market view, basic views on the market data, for example, that might apply to you. Let me move this over to the center here. That'll look a little bit better as well. Now, the watch lists, I feel, are fairly important. And you can track stocks that are in your current portfolio, just see the change today or the price change when you first open your account. And I have several lists here. I have watch list 3, looks kind of similar to watch list 1. Watch list 2, I put most of my indexes and ETFs in there as well. And that sort of is already shown. Some of those are, of course, already shown here on the market activity pod also. Okay, so let me go ahead and close that. Now, one of the things that's important, I feel, about the watch list, and it's very useful, let me go to watch list 3, for example, and I'm going to remove all of the current symbols. Okay? I say delete all selected symbols. Okay, so now I don't have anything in my watch list. Now, if you guys wouldn't mind, just send me over 1 stock each. Everyone who's online, just send me over 1 stock symbol, and we're just going to put it here into the stock symbol list. I'll go ahead and put in a stock here. I'll put in Apache. I'll type in APA and click Add. Okay, there's one, common one, IBM. I've got Apple. Okay, let me go ahead and put in Apple as well. Netflix. Okay, was Netflix the one that really dropped today, or was that Amazon? NFLX. Oh, no, Netflix went up. I apologize. It was up a little bit today. And I said Amazon. I'll put that one in there as well. All right. Okay, that's the one I was looking at, that bear call credit spread that had dropped. Okay, so we now just have 5 stocks in there. Let's leave that alone for now. Apple, Amazon, Apache, it's oil stock, IBM, and Netflix. Okay, now, if I wanted now to just look at let's say some basic covered calls. Let's say I wanted to see the February at-the-money covered calls on just these stocks. All right. Or the near-term at-the-money and out-of-the-money covered call for my 5 stocks in watch list number 3? Well, I'm going to go into the covered call tab, and we're going to select the search tool, just as we did with the calendar spread. This allows us to search across the universe of options to identify only those positions that match our criteria. Again, I'm going to clean this up a little bit. I'm going to click that See More or Less Columns button up at the top. It'll take me to the configuration page. I'm just going to hit the Reset to Default Settings there. And I'm going to scroll down and click Save and Return. Let's close window, and there we go. Okay, so here's the covered calls that match that default criteria set. And of course, there we are, initial values at the money. It's usually the default search when you first open a search screen in any of the strategies. And we will have some defaults set for you. Here's an in-the-money default screen and out-of-the-money default screen. This is for covered calls, of course. Price Watch Alerts number 1. These are the general settings that are used in those emails you might be receiving, the Price Watch Alerts and morning updates. The simulated CD search and the stock price momentum, those 2 searches are based on tip sheets that we have available in the tip sheet menu. Now, what I'm going to do is leave the initial value search, and what I'm going to do is scroll down to the bottom, and as we did before when I was looking for the weekly series, I'm going to hit Clear These Settings. I'm going to empty everything out of my parameter field, and I'm going to start from scratch. What I wanted to do is look against just those 5 stocks in my watch list number 3, and I'm going to look for the February expiration, next available month, and I want to limit it to just show maybe the 1 strike in the money, the at the money, and the out of the money covered call. So using my show in the money and show out of the money fields, I'm just going to use the number of strikes. I'm going to leave the first field blank to 1. So I'm telling the system, show me only those strikes that are no more than 1 strike in the money. And I'll do the same on the other field for show out of the money. I'll go number of strikes blank to 1. So only those options that are at least no more than 1 strike in the money and no more than 1 strike out of the money. Now I'm also going to want some basic information. Just because it was one of the 5 stocks, I'm looking for covered calls on one of my 5 stocks there in that list. Well, I want to make sure that there's some decent premium. I also want to make sure that I'm maybe getting a good return. So let's just put in a percent if assigned return of at least 1%. I know that might be below some of your requirements, but let's just use that as a default. Percent if unchanged of greater than 0. Option volume today, let's see, just basic liquidity of greater than 0, and open interest, let's just say greater than 10. And I'm also going to put a field in here for option bid price of greater than 20 cents. Why not? Okay, just some basic settings. Now, I've got about 15 to 20 different option criteria I can continue to filter by, and about 20 to 25 different stock criteria. What I want to do is just look at my 5 stocks. So what I'm going to do is scroll down to the bottom. In that recommended list section that we used before, where we could screen just against the IBD 100 or IBD 50 and canceling list, and we screened specifically for the indexes, ETFs, and holders, or chose to remove the indexes, ETFs, and holders. From my recommended lists, I'm just going to go ahead and select watch list number 3. So the stocks I put in my watch list are now available in every search for me to screen against specifically. So let's go ahead and hit submit, and let's see our results. Now we're sorting these by highest percentage return if assigned and lowest. So we do have 16 results, and we had 5 stocks. If I only had 5 stocks, why do I have 16 results? Because remember I said I want to see the in the money, the at the money, and potentially the out of the money call. So here's the first position with the highest percentage return if assigned is Netflix, buying the stock at $217.98 and selling the 220 call for $7.75. This gives us 3.6% downside protection and roughly a 4.6% return if assigned, but we do only have about a 46.5 probability, 46.5% probability of earning that return. But you'll notice I have another Netflix position here, that 217, the 220 is essentially an out of the money call. Well, I also have the February 215 strike. Well, that's at the money, slightly in the money. This gives me a little bit higher downside protection, a little bit higher percent return if assigned, and of course a higher probability. Well, there's more Netflix positions. Here's one. Oh wait, there's the February 220 call again. What's the difference? Well, Netflix happens to be one of those stocks that offers weekly options. Notice in the days to expiration, the number in parentheses, the 22 days tells me that this is the natural expiration. the third Friday of the month of February was 22 days remaining to expiration. And then the other one here, this is showing me that we have 7 days to expiration. That's the weekly option that expires next week. But you know what? Still matches my percent return if assigned. Does have a low probability, and I do receive some downside protection. Ooh, there's another one. I bet you this one's the weekly 215. Yes, it is. A 1.8 potential return if assigned for a 59.1% probability, or 3.1%. Well, if I wanted to get a better view, since I'm screening just by my stocks, and I wanted to see these stocks compared against each other with the weekly options, rather than sorting by percentage return if assigned, let's scroll back down to the parameter field there, and I just want to sort the position now by company name. So let's just scroll through our list. Any of these filters for the options or for the stocks that you can screen by, you can also choose to filter by, or that you can filter by, you can also choose to sort by. I phrased that poorly. So let me go ahead and click Submit these settings, and now we have our 4 Netflix positions right at the top. So we have our 22 days remaining to expiration there, and our weekly options with the 7 days remaining to expiration. Now, if you look at this just by raw numbers, you might say, well, this offers me a better potential return if assigned. The February 220 with 22 days remaining to expiration offers a higher percent return if assigned, so I might choose that one. Well, as many of you know, if I'm comparing selling premium, whether in a naked put, a covered call, a bear call credit spread, as we looked at a little bit before, even on the calendar spread, if I'm comparing selling the February call against a long call position versus selling a March call, it's not fair, it's not conducive to compare the static percent return. What you really need to do if you're comparing options with a different expiration when you're selling premium is you need to compare it to the annualized return. Well, let's go ahead and select that. So I have my percent if unchanged and percent if assigned. The percent if assigned, of course, remember as we talked on the covered call, that's the maximum return I could make if the stock was trading above the strike price of my call at expiration. And the percent if unchanged is the return I would make if the stock stays at the same price. Now you notice, real quick, look at the first 2 positions. The February 215 weekly option with 7 days left to expiration, and the February 215 option, call option, with 22 days remaining to expiration. My percent if unchanged and the percent if assigned for these 2 positions are equal. Why is that? Well, they're slightly in the money. They're below the current stock price. The percent if unchanged simply says, what would your return be if the stock remains at the same price between now and expiration? And the percentage of assigned, of course, is the maximum return you make if the stock's trading above the call strike price at expiration. Well, since we're starting off in the money, the stock's at 217.98, and we're selling the 215 call. If the stock stays at 217.98, we'll get assigned because we're starting in the money. Now, the out of the money call, the 220, notice how the percent if unchanged in both scenarios is lower than the potential percent if assigned. And that's because we wouldn't get the appreciation. If the stock stayed at 217, we wouldn't get assigned at 220, so we wouldn't get the appreciation. All right, back to square one. What I need to see now is probably my percent if unchanged annualized versus my percent if assigned annualized. So again, I'm going to click on that See More or Less Columns button. This will take us to the configuration page. Let me open that up full screen for us. And on the right is our option information, so all of the available fields that we could filter by, we can select to view in our results. And I want to see the percent if assigned annualized return. Now, I'm not going to check percent downside protection annualized. And further down the line here, we have the percent if unchanged annualized. It's down a little bit here below the percent if unchanged. So I'm going to just check those 2 boxes. And I can scroll down to the bottom, and when I click Save and Return, it'll just add those columns into the field. But what I want to do is actually click on Reorder Columns. I've already selected these 2, and the reason why I want to go to Reorder Columns is I want to move the percent if unchanged annual. I'm going to highlight that. I'm going to put it right next to the percent if unchanged, or right after the percent if unchanged. I'm going to do the same thing with a percent if assigned. I want the annualized percent if assigned right after the static percent return if assigned. Okay, so just adjust those 2. Let us click Save and Return down at the bottom from the configuration page. Again, we're going to be prompted to close the window to refresh the page. All right, now we still have it ordered by company name, so I'm looking at my 4 positions again on Netflix, the weekly options combined with the standard February options that expire 22 days from now on the 3rd Friday of the month, technically the 3rd Saturday. So what I can see now is that even though the February 220 strike, it was 22 days out, has the highest static percent return if assigned, it doesn't have the highest percent if assigned annualized return. That would be the weekly option, the weekly February 220. And even the weekly 215 that had only a 1.8% static return if assigned has a 91.8% annualized return. Now, normally I don't prefer to use the annualized return when I'm analyzing my results if I'm looking at the same month to expiration. I think it's a little bit exaggerated, and that makes the assumption that you're going to be able to do that month by month by month or week by week by week by week. That's sort of tough to assume. You're going to have some losses mixed in there. You're going to have to make some adjustments, of course, mixed in there as well. But when comparing different expiration time frames, whether it be a weekly versus a standard expiration, or you're comparing 2 different expiration cycles, you're going to want to look at the annualized percentage return or the annualized percentage return if unchanged. For the calendar spreads, as we looked at earlier, you're going to want to look at the annualized max return. It's not really a percent if assigned, it's more of a max return. Okay, now, the main reason we got onto this, this screen here is what I was talking about was with the watch list. So once you create a watch list, you can screen just against the stocks you're tracking by simply selecting it in any of the searches, any of the strategies. It will be reported, or recorded I should say, and available for you to select in the recommended list. Now, you can create your own personal list. If you have a list of 50 or 60 stocks that you track on a regular basis and you just want to screen against those in a given strategy, you can do that just by clicking on the Create and Modify Lists link above the Recommended List dropdown. So when I click on Create/Modify Lists, this will take me to the Recommended List page. And you see I have some of my created lists, an example list, the large combined list here, large list number 2, and so forth. Open discussion from 514, that's a pretty old list. The open discussion, and watch list number 1, watch list number 2, and watch list number 3. Now it shows me the number of symbols in each one as well. So for watch list number 3, we just deleted the original symbols and we created a list with 5 symbols. But if I make a change here, let's go ahead and edit our list. So I'll click on Edit. You have Apple, Amazon, Apache, IBM, and Netflix. Those are the stocks that we put into the list. Now, if I wanted to add some stocks to this, let's go ahead and do that. I'll put in Kraft, KFT, SLV, the silver ETF. Let's see, I'm sorry, we've got Apple, we've got IBM in there. Let's see, Cisco I could put in there. Intel. Just putting in some standard stocks, Walmart, WMT, for example. Okay, so I'm just adding these symbols into here, and I'll go ahead and click Save. And now we notice that, okay, it already did it for me. My watch list now has 10 symbols. Watch list number 3 now has 10 symbols in my recommended list field. Well, all right, let me go ahead and close the window. It's going to ask me to resend the information. We'll do that. Now, oh, what happened? I didn't change any of my search screens, my parameters. We didn't change any of the parameters. It kept those for us. We still have the watch list 3, but it automatically updated it for us when it resent the data. So now we have 25 results. Our new symbols were automatically included in that static search that we ran. So here's Kraft. Doesn't have weekly options, so we only have 1 results. Here's the SLV ETF that I selected, and we do have multiple results here, and that's because we have weeklies and standard expiration options. Again, 7 and 22 in this scenario. Cisco, there's another one, has weekly and standard expiration. So it added those to our new symbols in our search. Now, what else is unique? Let's go back to the main home tab now, navigate away from our search screen. We want to go back into the main home tab. I'm sorry about that. And look, when we changed the list in our search screen, when we changed the recommended list, our watch list was automatically updated as well. So Walmart, SLV, let's see, it was Kraft, INTC, Cisco, SLV, and Walmart were already added into our watch list number 3 when we changed the listing of the symbols in the search function. Okay, so they work hand in hand with each other. Really quick updates, and you can screen just against those stocks in your watch list, and if you update the recommended list, it'll automatically update your watch list for you. All right. Now, I'm going to navigate back over to our slide presentation. It's 5:25 p.m. Eastern Time, just about at the 5:30 time frame when we wrap up the session. But as I am navigating over to the slide presentation to wrap up, if you have any last-minute questions, go ahead, and send those in for us, and I'll stay online and answer those. No problem. But let me go ahead and navigate over. Oh, don't want the highlighter. Let me get off of that, go back to the main area. There we go. So just the basic subscription cost for PowerOptions. Our 20-minute delayed service gives you access to all of the tools in those 23 different strategies. Is only $59.95 per month, about $60 per month. And we do have a discounted rate. If you sign up for the yearly subscription, it's only $600 for the year. So you're essentially paying for 10 months but receiving 12 months of service. An upgrade to that, we do offer a real-time service where if you're running your searches or you hit the submit button, you're receiving the data in real time. You're getting real-time quotes at that very instant. It's not streaming real time. And that's only about $20 more. It's $79.90 per month or $800 for the year. Again, paying for 10 months but receiving 12 months of service. Now we do offer a historical suite of tools. The historical data is not available on the 20-minute delayed or the real-time subscription. If you're on the 20-minute delayed or the real-time subscription, you can subscribe to a 3-month access of our historical tools for $99.95. I'll give you 3-month access to the historical tools. But if you're already on the real-time, it's actually cheaper per month just to upgrade to the professional level of service. It's only $20 more per month, roughly, up to $99.99 per month. The professional level of service includes everything on the real-time service, plus unlimited access to those historical suite of tools, the historical search by symbol, and the historical option chain. And of course, the discounted rate is $1,000 per year. Essentially, you're paying for 10 months but receiving 12 months of service of the real-time quotes and unlimited access to the historical suite of tools. All right, our upcoming webinars for next week. Every Tuesday and Thursday at 12 noon, Kurt Frankenberg hosts his radioactive trading presentations. I usually join him for those. That's discussing the radioactive trading techniques using that unique form of a married put to enter into limited risk, unlimited upside profit potential. And he'll usually discuss 1 or 2 of the 10 different income methods he uses to adjust those positions. Every Wednesday, or this Wednesday actually, at 9 p.m. Eastern Time, Wednesday, February 2nd, I believe it is, at 9 p.m. Eastern Time, I'm hosting part 2 of my PowerOptions, using PowerOptions for radioactive trades presentation. Part 1 last week, was an hour and 40-minute presentation actually on just using the married put PowerOptions search screen to identify radioactive trades. This presentation next Wednesday at 9 p.m. Eastern is just going to be a basic follow-up to that presentation. We're going to have an open Q&A session like we did today on using the PowerOptions tools for radioactive trading. That'll be Wednesday at 9 p.m. Eastern Time. Every Wednesday at 12 noon, I host an Introduction to PowerOptions presentation. That's essentially an hour and 15 minutes of walking through the tools, and I'll show you how I use the tools in a given strategy to identify positions, use the more information buttons on the search tools to further research and analyze the stock and the option and compare it to other combinations, and then of course using the portfolio tool to paper trade and track the positions. And of course every Friday at 4:30 p.m. Eastern Time we host the open discussion presentations. Come bring your questions just like as we did today, and the whole idea is just to have an interaction, answer your questions as they come up. Or you can just come and join and see what questions other PowerOptions customers are asking. Now, if you have questions or you think of something, of course, after the presentation, I want you to feel free to contact us at any time. You can send us an email to support@powerop.com, or, of course, you can call us toll-free during market hours if you live inside the continental U.S. at 877-992-7971. Or, if you live outside the continental U.S., you can reach us at 302-992-7971. And there are contact links on every PowerOptions page. All right, well, I didn't see any other questions come in. So ladies and gentlemen, I want to thank you for joining me on this Friday afternoon, going into Friday evening, of course, for the open discussion presentation. I hope to see you all next week at one of our other live webinars, either the Introduction to Radioactive Trading presentations, Tuesday and Thursday at 12 noon Eastern Time, or the Introduction to Power Options presentation, Wednesday at noon. And of course, part 2 of our series of using the Power Options tools for radioactive trading would be Wednesday at 9 p.m. Eastern Time, or, hey, next Friday, 4:30 p.m. Eastern Time, open discussion presentation again. Take care, everyone. Have a fantastic weekend, and we'll see you next week. Good night.